Welcome back, everybody. This is Peter Spina, President of GoldSeek.com. We want to welcome you back to our next GoldSeek.com live event. Today we have two presenters, Craig Johnson, President and CEO of Prophecy Platinum Corporation, and Jay Taylor, editor of the Mining and Tech Gold and Tech Stocks newsletter. We'd like to begin today with Craig Johnson. He is the President and CEO of Prophecy Platinum, as I mentioned. Craig Johnson has over 25 years of experience in exploration and development of large-scale projects in the mining industry, and through his global network of contacts has raised over $650 million in project financing. Previously, Greg was the President and CEO of South American Silver, which developed two projects in South America. He's also the co-founder of Nova Gold and was part of an executive team that built Nova Gold from the $50 million market cap to more than $2 billion market capitalization, which in that period saw the company's resource base grow to over 30 million ounces of gold. So at this time, I'd like to introduce and hand over the presentation to Greg Johnson, and at this time, he'll be presenting Prophecy Platinum Corporation. Greg, thank you for joining us today.
Thank you very much. Go ahead and show the screen here. So we're going to be presenting on Prophecy Platinum. This is a relatively new company. It's an exciting time to be in the platinum group metals space. For those of you who have been following the market over the last couple of years, the PGM space has been one of the better performers. Platinum and palladium have outperformed gold on a relative basis, and there's a lot of interest in the space, particularly with the concentration of production in South Africa, where due to the mining conditions in South Africa and some of the social and energy issues, the market is paying close attention to that area, which produces about 90% of the world's platinum and palladium. Prophecy Platinum is located in the Yukon, and a second project in Ontario. We're a development stage company, and in the presentation we're going to go through a quick snapshot of the company's projects, our project in the Yukon called Wellgreen, and our project in the Ontario Sudbury Mining District called Shakespeare. First would direct investors to take a look at our forward-looking statements, and particularly we advise investors that it's a good thing to take a look at company's annual information form, which discuss in detail some of the risks in looking at development stage exploration projects, and these documents are worth reviewing. So as an overview of Prophecy Platinum, our team, the new team here at Prophecy Platinum, joined the company almost a year ago now. We are a heavily technical team of geologists, mining engineers, and mining finance expertise. We were all quite excited to come together on this project last year and to take it to the next stages of development. The Wellgreen project is one of the largest undeveloped platinum group metal resources in the world because of its location in the Yukon Territory just off the Alaska Highway. It has excellent infrastructure for a northern project in particular. It is unique in the platinum group metal space in that it is potentially an open pit mining situation, which could be amenable to bulk underground mining as well. The project was put into production back in the 1970s as a former high-grade underground producer, and our metallurgical test work indicates that this project could be developed as a significant open pit metal concentrate producer that would likely be shipped to Asia. In addition, the local First Nations have signed an agreement on the project and have settled their land claims with the Government of Canada, which really sets this project up to be able to move in a timely process through the permitting. Our Shakespeare project in the Sudbury Mining District of Ontario likewise is a former producer. It operated between 2008 and 2012, This project, though smaller than Wellgreen, has the potential to move rapidly back into production and to be a cash flow generator for the company. The market capitalization for the company right now is just around $50 million. We've got 77 million shares outstanding, and we've got a great share structure of institutions such as Sprott Asset Management, just under 10%, a number of large private investors, management, as well as a large retail following of the company. Prophecy Coal has been our largest shareholder, and there's been a recent announcement that they are selling their block to a number of investors, long-term investors, which we believe it really is a strong indication of the interest in the company. The company is well funded. We raised about $5.9 million this summer. We have an active exploration program out at Wellgreen, and we are looking to put out significant news over coming months as we advance the project towards development. So if we take a look here on slide 4 at some of the key elements of the company, and we look at this relative to other projects in the precious metal space, there's a number of factors that really stand out. As I mentioned in the introduction, the fundamentals for the platinum group metal segment of the market are probably some of the strongest in the precious metal sector, in part because of growing demand year on year for the metals, particularly in catalytic converters, with a really falling supply because of production issues out of South Africa, which is the world's largest producer, as well as out of Russia. In addition, the location of the project in the Yukon as one of the top mining districts in Canada really is very favorable and illustrates the low political risk of this situation. The exploration potential on the project is really exceptional. This is a district-scale opportunity. We already have 3 major targets, with Wellgreen being the most advanced, but we think the opportunity to grow this is quite significant. The management team not only has expertise in advancement of development stage resource assets, but has specific expertise in developing mines in the Yukon, as well as expertise in operating platinum group metal mines throughout Canada. The production profile on this project is significant. As you'll see in some of the following slides, this could be one of the largest producing platinum and palladium mines in North America, and has potential, particularly as an open pit mine, to be very scalable, to be a significant producer, perhaps the largest in North America. Already, with 7 million ounces of platinum group metals plus gold, 2 billion pounds of nickel, and 2 billion pounds of copper, this is an extremely large resource. Anything over 5 million ounces would be considered world-class in scale. So when you combine all these elements, that really brings together a picture for why investors are so interested in taking a look at Prophecy Platinum at this stage. The team here at Prophecy Platinum, my background, as Peter mentioned in the introduction, I've got about 25 years of experience in the industry. Started out my career with Placer Dome and Barrick, was a co-founder at Nova Gold, and president and CEO at South American Silver. Much of my career has been involved in the advancement and fundraising for projects. John Sagman, our Chief Operating Officer, joins us with significant expertise in mining and mine construction development, particularly with groups like Placer Dome, Barrick, Xstrata, Vale, and Capstone. Jeffrey Mason, our Chief Financial Officer, joins us from the Hunter Dickinson Group. Jeffrey has been involved in a number of large development projects throughout his career. In addition, we've been building on our team at the project level and have significant expertise in the platinum metals, the engineering, metallurgical, and geologic fronts. And we think this is going to be important for adding shareholder value as we go forward. So if we take a look here on slide 6 at how Wellgreen stacks up against the other producing mines based on our current engineering estimates, you can see on this chart production in platinum and palladium, with the left-hand scale being platinum production, the right-hand scale being palladium production. And the chart is scaled to give you a sense of relative value, because in today's market, platinum is about twice as valuable as palladium. You can see the scale here. So the Stillwater mine is the largest producing asset in North America. And you can see the value is dominated by palladium, followed by Vale's Coleman mine in the Sudbury district. And based on our PEA from last year, our first engineering study, you can see that this was potentially the third largest producing platinum palladium operation in North America. Because this has quite conservative assumptions relative to metallurgy, we believe that there will be opportunity to improve on these numbers, and that potentially with advancement and ultimate scale-up, this project could be one of the very largest producers in North America. You'll note that the production of platinum and palladium is relatively balanced in terms of total ounces produced of the two metals, so that also gives the project very significant upside to palladium in particular, as many analysts believe that the relative performance of palladium will continue in future years to be slightly better than platinum. Looking at the kind of peer groups in the sector, one thing that's quite notable is just the scarcity of development stage projects in the platinum group metal space. In first world jurisdictions, you have two producers, North American Palladium and Stillwater. You can see them scaled here relative to their resources in the ground. On the development side, you have about 5 peers. You've got Duluth Metals in Minnesota. You've got a project in Greenland for Platina. You've got our project in the Yukon, Polymet in Minnesota, and Pacific Northwest Capital in Ontario. So if we were looking at the gold industry, there will be hundreds of development stage projects to consider. In platinum and palladium, really outside of South Africa, there are very, very few significant projects for investors to look at and for the major mining companies to consider in terms of opportunities for acquisition or joint venture. If you look at the valuation here on slide 8, you see a very similar pattern to what you would see in the gold market, in the silver market, where the producers trade at the highest multiples and an enterprise value per ounce basis. You can see here the two producers, Stillwater and North American Palladium, trading at an average of about $129 an ounce in the ground. At advanced development stage, this is feasibility just before going into production. You can see that the average in the industry right now for the two U.S.-based assets is around $27 an ounce. And you can see the average for the 3 earlier development stage, including ourselves, is around $3 an ounce. So our business plan is really focused on building the team to advance our asset to advanced development stage. As you can see, potentially on an enterprise value per ounce basis, that could be, if we were to achieve an average valuation, almost a 10-fold increase in relative value as we de-risk the project. One factor to bring into consideration here as well is that often this is the phase, at the early phase, where you see the most significant resource growth. And so oftentimes when we look at examples of other companies such as Nova Gold, Detour Lake, Ivanhoe Mines, and others, investors saw significant growth in addition to de-risking and revaluing the assets, included expanding the resource base. If we take a look just for a minute at some of the fundamentals, there's a few highlights here on slide 9. What you'll see is that a couple of factors. One, you can see the concentration of global supply of platinum and palladium from high geopolitical risk areas. South Africa and Russia dominate the production profile for both metals. In addition, both for platinum and for palladium, we've seen a situation where since 2006, production has significantly been falling on a mine supply basis for platinum, and since 2004 for palladium, based on basically constraints in the ability to produce metal from those two countries. In addition, about 70% of the platinum producers today are not meeting their all-in cost of production at the current average price of platinum, which means that we're seeing a lack of reinvestment, a lack of investment into exploration, and potential future further constraints in supply. If we look at where platinum and palladium are used in the world, we see that most of the production goes into industrial uses, particularly catalytic converters, so vehicle sales, particularly in the growing third world, brick region is very, very significant to this market, and we've seen pretty much year-on-year growth since the 1980s in that demand. If we look specifically at platinum and palladium supply, looking here on page 11 at platinum, what you'll see is since the 1980s, about a 4.4% annualized growth rate in platinum demand. And on the supply side, you see that pronounced fall off in mine supply peak in 2006, really demonstrating that disconnect between increasing demand and falling supply. On palladium, you see a very similar pattern, about a 5% annualized growth rate since 1980s, and you see the peak in 2004 in terms of mine supply. The orange bars on the top on the right-hand side really are recycling. If we didn't have recycling in the market today, mine supply would not be able to meet demand just for catalytic converters. So it's very, very strong fundamentals in terms of increasing price in these these metals going forward. So now let's talk a bit about the projects. If we take a look at the Wellgreen project, this is a photo of the project area. You're looking up the access road that comes off of the Alaska Highway. It provides us year-round access to the project. This project is located several mountain ranges in from the coast, so it's actually a relatively arid environment, even though it is cold in winter. So this makes for excellent conditions for mining. As I mentioned at the introduction, the project was discovered in the 1950s, put into production as a high-grade underground operation in the 1970s, and the work since about 2000 has been focused almost entirely on looking at the open pit potential as a bulk mineable deposit. This slide here on 14 shows the location of the project just off the Alaska Highway on the lower left-hand side of the slide. It would give us access by paved highway to the ports at Skagway or at Haines, which are the same ports that are currently used by Minto, the Minto mine for capstone mining, as well as Alexco Resources. It's about the same shipping distance for the project. So this is a real advantage to have already road infrastructure and port infrastructure in place, and will significantly aid maintaining a low capital investment structure for the project. If we look on slide 15, you get a sense of the immediate area around the project. You can see the highway on the upper right. You can see the all-season road that comes into the camp, and you can see the location of the resource in the red area on the backside of the mountain range from the highway. This area is, as I mentioned, an area that we can work year-round, and with the underground working still accessible, it allows us to be doing a combination of both underground drilling as well as surface drilling, which helps to maintain our low-cost structure. If we compare the Wellgreen project with other major producing platinum group metal projects, particularly in South Africa, the famous Bushveld district, what really stands out is the contrast between Wellgreen as an open pitable deposit with very wide widths of disseminated mineralization versus the typical deep, narrow seam underground mining that we see in most of the Bushveld. The largest projects in development right now are Ivanhoe's Flat Reef project and Platinum Group Metals Waterberg projects. The thing that's notable about those is that they're wider zones that are potentially mechanizable mining, which will result in lower costs. But in comparison with the widths that we see at Wellgreen, you can see that the zones that we'll be looking at starting right at surface are significantly wider, and that the overall grade thickness is significantly better. So this should aid our economics in being a low-cost operation, and should really make this a very attractive project. Looking at the photo here on slide 17, you're looking across the western and central part of the deposit. The purple areas represent the areas of our ultramafic rocks that host the mineralization. Much like diamond deposits, these ultramafic rocks are the host of our mineralization. They're very rare geologically. They only occur in a few places around the world where they're mineralized, and Wellgreen is really one of the largest complexes with some of the widest widths we've seen. If we take a look at an example of a cross-section here on this photo through section C, the central zone, it'll give you a sense of what that's like looking at that cross-section. And what really stands out on this section, you see two drill holes testing this zone. is the exceptionally wide zones of continuous mineralization. The bars on those on the two drill holes represent the grade in platinum equivalent of the mineralization across the zone. And you can see the very continuous nature of that mineralization, averaging right around 2 grams per ton platinum equivalent. What I might note also are these much higher grade zones of significant thickness, which could be mined as bulk mineable underground targets, which is part of our thinking for this next round of engineering. If we look at a second cross-section through the far east zone, this is an area that we've recently put out a news release on a new discovery of a new mineralized zone. Here on the FE section, what you'll see is that we have, in addition to the main tabular zone of mineralization at Wellgreen, we have a second zone of mineralization that's been discovered that is also several hundred meters thickness and in places demonstrates exceptional grade at over 4 grams per ton across 60 meters. One of our drill holes this year was designed to cut across this zone, and though we're still waiting for final assays, it intercepted 800 meters of continuous ultramafic rocks, which have disseminated sulfide mineralization in them, which is by far the largest geologic intersection we've ever had. At this eastern end of the deposit, we're quite excited as the two main zones come together at the exceptional width and grade that we're seeing in this zone, and it's quite an exciting area for us to be looking at for potential expansion. Additional metallurgical work has been underway as part of our program this year, improving on the previous initial metallurgical test work. So far, our interim results are suggesting excellent improvement in overall recovery. We are looking at recoveries for copper that are in the 90% range, nickel in the 70s, and we're looking at PGMs that are from 60 to 75% recovery, which are a significant improvement over those that were used in the preliminary economic assessment published last year. This work will continue, and this will be part of the updated engineering that will be coming out likely early in the second quarter of next year. The economic assessment that was completed on the project in 2012 demonstrated a robust project using conservative metal prices. We are now looking at a staged startup approach on the project that could be reduced capital. We think we're going to see a number of improvements in metallurgy, energy, and the inclusion of value from the rare PGMs that should make this next update an exciting and significant enhancement to the overall project economics. As I mentioned earlier, because this is a polymetallic project with multiple metals and an open pit mining configuration, it should be in the lower quartile of producer costs, which should make this project very attractive as a potential project for partnership, either with smelting groups looking to offtake the metals for their smelters, or for major mining companies potentially interested in production outside of high political risk areas. On the exploration upside as well, we've really only begun to explore the main Wellgreen resource area here on slide 25. And what you can see is the areas of stippled rock indicate other areas of ultramafic host. And with the historic work that's been completed on these areas, we have believe there's excellent opportunity to develop a number of targets that could be developed, all of which are on the road and would reflect an easy ability to add those resources to any future operation. We've done a number of surveys, both in terms of magnetics as well as soil geochemistry, which indicate that these other targets have the same types of signatures as we see at the current resource at Wellgreen. And this is an area that really holds excellent potential for further work. As seen here on the geochemical survey on slide 27, really the Quill target in particular looks to be a continuation of the main Wellgreen resource, and the Burwash also shows excellent response here that we'll be looking forward to testing here on the project. The current program is still underway, just being wrapped up. It includes both resampling of historic drill holes as well as our current new drilling, and look to integrate that information into the next program. So what can you expect as an investor looking at Prophecy Platinum over the next year to two, finishing up this updated preliminary economic assessment early next year, integrating in the drilling and resampling program, integrating in the updated metallurgical test work should give us a significantly enhanced understanding of the project. That would move us in 2014 into pre-feasibility studies, in 2015 into feasibility studies, which could allow us to be looking at a construction decision sometime in 2015 or 2016. So this is a project that has the opportunity to move relatively quickly, and I think that the news flow over coming quarters should be significant. Last couple of comments I'll make will just be on the Shakespeare project. The opportunity here that we're looking at is updating the feasibility study that was completed and looking to bring this project potentially on stream again as a near-term cash flow generator. Right now, those studies are underway, and we anticipate being able to complete those studies by Q1 of next year. Potentially, this could produce cash flow on the scale of what would be necessary to advance Wellgreen through the development stages, and would allow the company to maintain its tight share structure and give that exposure and upside to its shareholders. So, in conclusion, I think if you take a look at the current market, it's certainly been a very challenging market over the last several years as we've seen continued downward pressure on the mining sector. If we take a look here on slide 33 at the miners versus metals index, we can see that we are at decade-level lows for gold miners index versus gold. The platinum mining index has less history, but it appears to be the same pattern shown in green on the right-hand side of the chart. So I think the period we're looking at, we're hopeful that we're getting through the worst of this very challenging market condition. I think investors looking at high-quality names in the sector have an opportunity in this current market to be buying things at exceptional values. And I think that we look forward to, as we advance our projects, an improving market tone in the sector should allow us to deliver exceptional performance, and look forward to speaking with many of you in the future as potential investors.
Great. Thank you very much, Greg, for the presentation of Prophecy Platinum. For those looking for more information on the company, they can go to your corporate website, which is Prophecy Plat, which is P-L-A-T, prophecyplat.com. And as well, I'm going to go ahead and send through the chat window a link to Simon Russell, GoldSeek.com's mining analyst report on Prophecy Platinum. I'm an investor in platinum. I own physical platinum, but I only own one platinum stock, which is Prophecy Platinum. I find having a low jurisdictional risk, which Prophecy Platinum has being in Canada, is enormous upside. And as those who read GoldSeek.com know, the platinum market is quite interesting. It's getting extremely interesting at this time. I believe it is likely to continue to outperform gold, and with that combination, Prophecy Platinum is in a really good position to capitalize on that. So at this time, I'd like to go ahead and thank Greg. Thank you very much for your time today, Greg. We're going to go ahead and switch over now to Jay Taylor. Go ahead and switch over presentation there. So at this time, I'd like to introduce Jay Taylor, who is the editor of Jay Taylor's Gold, Energy, and Tech Stocks newsletter and host of the web-based radio show, Turning Hard Times into Good Times. Jay has been publishing his gold-oriented newsletter since 1981 and has had an extensive period investing in mining companies and in the sector. So, Jay, thank you very much for joining us today. I'll go ahead and hand it over.
Thank you. Thank you, Peter. Thank you for the opportunity to talk to your audience. I really appreciate the opportunity. I would like to talk a little bit today about what I think is a major disconnect between the mainstream's view of the economy and what I think is really much more accurate, and what impact that will have on the kind of things we should invest in. Primarily, I believe what we're looking at is a major deflationary force, essentially at a time when when there's enormous amounts of money that's being created. That seems counterintuitive to most people, probably because, let me just back up here, I'm in the wrong slide. My apologies here. Let me get back to my first slide, and then we'll be ready to go here. I might, just before I get started, just mention a little bit of a commercial for myself. J. Taylor Media is probably the best place for people to go to keep up with everything I do. I host a radio show called Turning Hard Times into Good Times. It is every Tuesday between 3 and 5 New York time. And I have a lot of very interesting guests on there, people like Congressman Ron Paul, Daniel Estulin, Dmitry Orlov, Doug Casey would be known, Eric Sprott, of course, Jim Rogers, Eric, just a lot of very, very interesting people, Lou Rockwell, John Perkins, Richard Mayberry, Rick Rule, a lot of people that would be well known to your audience as well. So it's every Tuesday between 3 and 5 at Voice America. You can access it through J. Taylor Media. Just click on the radio program, and it will take you right to my radio show, and you can download it on iTunes. So, I'd like to talk a little bit today about the deflationary forces in a money printing world. We're certainly seeing endless quantitative easing, and I know Peter, you and I have talked about the notion that there's just no way that quantitative easing can be stopped. That, of course, the conventional wisdom from the mainstream is that it has to be stopped, that there's going to be some sort of a reconciliation back to normalcy. And I don't think there's any kind of easy soft landing coming our way, in large part because I don't think the policymakers understand the origins of the problems that we're having. They are basically programmed to believe in Keynesian economics, which is really a feel-good economics notion. The whole idea, I think, is the notion that it's all psychological, that the economy is psychological and it's not based on reality. Deflationary forces, I think, are very, very real, and they're not psychological. But if you look at, well-known economists like Robert Shiller, it says the second coming of the Great Depression is, like the original, a direct result of no animal spirits. If only we had factored those turbulent emotions into economic theory, we might not be repeating the earlier tragedy. And of course, those of us who look back at the 1930s, President Roosevelt said we have nothing to fear but fear itself. And of course, the whole notion of animal spirits was coined by John Maynard Keynes. So that is what our mainstream media is running on. And we have all of these familiar faces telling us every day that things are not all that bad, they're going to get better, and all we have to do is keep doing the same thing. It was Albert Einstein, I believe, that defined insanity as continuing to do the same thing and expecting different results. Well, that's what we're doing. Our policies are aimed at generating animal spirits by throwing money into the system. And the problem with that is that when we're in a fiat currency system, it is really, debt is the raw material from which money is created. So the more money that's created, the more debt is created. And so what we're having is a massive amount of indebtedness that is really causing a drag, and I think really a continuation of a depression that we've never really come out of to any great extent since the Lehman Brothers problem. And I'll get into some numbers and some charts in a few minutes that sort of back up that view. So what I think we're being afflicted with is a lot of big lies by the mainstream that are trying to keep us happy, to keep the animal spirits alive. Inflation is less than 2%, we're told. The job market is improving, we're told. The economy is getting better, maybe albeit slowly, but it's getting better for sure because we're continuing to print more money. So this is the main sort of mantra that we're given every day by those pretty faces that we see all the time on CNBC and the other mainstream media. What has been happening, of course, is that we've had a huge amount of money creation. It's just exploded. And, of course, this trend started when Nixon took us off the gold standard, the international gold standard, in 1971, but it's been accelerating. And the system needs, in order to keep from imploding into a deflationary depression, the system needs to have more and more money being created at a faster and faster rate. Well, as you can see from this measure, the true money supply, that it's growing almost exponentially, and we're seeing, this crazy amount of liquidity pumped into the system, but it isn't really gaining any great traction. What instead we're seeing is a replay of what happened in the 1930s. Is the money would go into the banking system, but it wouldn't get lent out. It just sticks in the banking system because there's no confidence that there are borrowers out there that can repay it. And also, of course, the Fed is encouraging the banks to keep money in by paying them a small amount of interest on money that they keep in the system. I'm quite sure that's because the Fed realizes that the banking system is still in wretched shape, that there are so many bad loans on the books of these banks that cannot be repaid, that in fact what they're doing is encouraging the banks to keep money to keep reserves, excess reserves there. But we've had this explosion of excess reserves from virtually zero to over $2 trillion at the present time. And using the true money supply plus excess reserves, we're seeing an 83% increase since Lehman Brothers and the market panic a couple of years ago. Of course, this has had its benefits on Wall Street. And we're seeing new highs in the stock market. The Dow Jones and the main broader indices are all showing robust increases, and so Wall Street is quite happy. And so, if you're one of the privileged people that have money and you're able to invest it, then you're not all totally unhappy with this scenario. I think the animal spirits are back to a great extent, among Wall Street at least, among the people with the money. They are no longer believing at this moment so much in gold or tangibles. They really sort of have placed their faith again in the Keynesian economics and Mr. Bernanke's ability to perform. I showed you the slide of the Dow Jones. If we look at something I've put together called my inflation-deflation watch, which is really a composite of equity prices, it covers sort of like retail, it covers energy stocks, it covers the broad indices as well. Copper's in there. Among the commodities, copper, we've got oil and gas and that sort of thing. Jimmy Rogers' Raw Materials Fund is in there to give us a broad-based commodity index. It's a non-weighted, not back-tested, but what I started doing is putting this together in 2005 just to sort of keep a sense as objectively as possible as to whether or not the global economy is expanding, and that is if prices are expanding, I should say, not the economy. But if we're inflating or deflating, if the system is inflating or deflating, well, you can see that after Lehman Brothers, we had a precipitous fall, a decline, a massive decline in my index, which of course was the stock market and the commodity prices that just plunged. We actually experienced an actual deflation during that time period. Because I started the index off at 100, it got down into the low 90s at the bottom of the post-Lehman Brothers trauma. But we can see, in spite of the fact of this enormous amount of trillions of dollars of money that's been pumped into the system, the inflation-deflation watch, we're not seeing a breakout as we did with the equity prices. If you took the equity prices out of this index, you'd be looking at a decline, a fairly significant decline, because the broad base of commodities have not performed all that well, oil being the exception. Energy prices have, at least oil, petroleum has done well, but otherwise a lot of the commodities are not doing well in spite of this huge amount of money that's been pumped into the global system, not just from the United States, but from China and Japan and elsewhere. Huge amounts of money created out of nothing. Well, when I say out of nothing, created with debt. So you have this enormous amount of new debt creation that is continuing to really burden Main Street. Wall Street is doing extremely well. And we are seeing this, of course, the hollowing out of the middle class. Huge amounts of money being transferred to the top 10%, and especially the top 1%, and huge amounts of money, and Wall Street and Main Street Main Street just not doing very well at all. I'll have some numbers very shortly. Of all of those Pinocchio characters that are giving us all the happy talk to try to keep our animal spirits high, I really believe much closer to the truth is John Williams, economist and author of Shadow Stats, a newsletter that I subscribe to and pay fairly close attention to, because I think John is he's an economist that had actually worked for the Bureau of Labor Statistics in the past, and he's looking back at unemployment measures consistent. If we use the same yardsticks as we used in the 1930s, we see a completely different picture. Apparently, in order to try to keep the animal spirits up, there's been a lot of spinning and lying and half-truths that are being told the American public with respect to the statistics. And that, I suppose, is geared towards Wall Street as much as Main Street to keep the people with the money believing in the system. But we have unemployment measures consistent with the 1930s as what John uses, inflation measures consistent with the pre-Reagan era when inflation numbers were really changed the way they calculated inflation. And so if we look at the actual growth using actual inflation numbers, we see that we've never come out of the out of the post-Lehman Brothers recession. This is a chart that shows the different measures of inflation that John Williams shows in his newsletter. The red one is the one that's quoted by the government, the one that they like to talk about most because it's the most favorable, and it's showing something around 7% now. The gray one, the gray statistic is also from the government, and that though includes a longer period of time. I think it's 6 months or so when people in the red one they drop people out. The red line drops people out of the labor force, and they just don't count people who are unemployed anymore because the assumption is they don't really want to work. And the gray one takes a little longer period of time. I believe it's 6 months. What Williams does is goes back and looks at able-bodied workers, and that's the blue line, and that's the one that they used in the 1930s. So if we compare apples to apples in statistics, we're looking at something north of 20%, 23% or so right now for unemployment in the United States. A far cry from the 7% that's claimed by the major media and by the government. And if we look at consumer inflation, the Williams numbers here show, over time, the inflation rate. If we use Williams numbers, and it goes back to the Reagan era, you can see that the two, the departure of these two statistics occurred during the Reagan years, and essentially a couple of things, basic things, were changed over the years. One was to start substitution. So if steak got too expensive, you just put hamburger into the index. And presumably if hamburger gets too expensive, we will all be expected to make do with dog food in the future. But in any event, that was one of the ideas. The other was hedonic pricing, which suggests that because you have all the bells and whistles on new cars now that you didn't have in the old days, that what you do is just deduct the cost of those bells and whistles. And so you're not really paying $30,000 or $40,000 for that car. Once you take all the extras off that you have now, you're paying $10,000 or something. And so so those are the tricks in the game of living, an inflation index, but we don't really have a cost of living index anymore. If we use Williams numbers to measure GDP. If we discount GDP by that higher inflation rate of 7 or 8% as opposed to the 2% the government says, then this is what you get. We've never really had any increase in GDP since the Lehman Brothers and since the recession that followed Lehman Brothers. If we also apply the same actual cost of living statistic to the wages of the American worker, we see that we are continuing to decline in his purchasing power. And this is why the middle class is being destroyed. The middle class cannot make ends meet. If we had that 2% inflation the government claims, it would be a much better picture. But that's not the reality. The reality is something much more akin to what some of the other statistics I'll be showing you in a minute. One is food stamps. the food stamp growth, the growth in food stamps is accelerating as that middle class, the real wages are declining and as unemployment is extremely high. So look at that enormous amount of food stamp growth from something around, it's doubled basically, almost doubled since 2007 or so. If we look at consumer confidence, and this I think is a very important comparison, look at consumer confidence and compare it with the real median household income. You'll see it looks fairly similar. Consumer confidence is up a bit, maybe a bit more than real median household income. Maybe all the happy talk has its effect as well on average people, and maybe things are slightly better, tiny bit better, but in reality, not that much better. So when they say all we need to do is just think positively, all we need to do is have animal spirits, I say that's a lot of baloney, because frankly, if I'm the father of a family of 2 kids and a wife, and I've got to make ends meet, and I don't have the money, and I tapped out of my credit cards, and I can't find a way to keep things going. Am I going to be optimistic? Am I going to be confident about the economy, no matter how much happy talk President Obama gives me and Maria Bartiromo and all those other happy faces at CNBC? I don't think so. It's not going to matter much to me. Wall Street is pleased because they're continuing to do well, and the traders that use sophisticated computer methods to pick the pockets of average people are quite pleased. But it's no mystery to me why the animal spirits are they're not there. They're not there because that's the reality. It's not psychological. It's reality. So this is the consumer confidence consumer confidence conference board, again, just showing that the consumer is not very confident. So what is the consumer? What is the average person doing? Well, not only the banks but individuals are not spending. First of all, consumers who tapped out with their credit cards can't spend. They don't have any more. Their incomes are declining. Their real incomes are declining, more importantly, than their nominal incomes if they have jobs at all. And so what's happening is the velocity of money, the turnover of money, people, when they get paid, can't go out and spend it and do things with it like they could during the happy days. And so they're hanging on to it. And banks are not lending because they know that there aren't those opportunistic loans to make right now. Credit card loans are down. I think we show, yeah, here we go. This is credit outstanding. The red, it looks like it's rising, of course, the total, but if you take out student loans, we're still considerably below where we were at 2008, 2009. So, and of course, the student loans is a government program, so government-backed program that makes it possible for student loans to continue to impoverish students, who will never be able to get jobs and never be able to repay their loans. It is an insane policy mix that we've got going here that is leading us deeper and deeper into trouble. This is another measure that John Williams shows that shows the move from M3 to M2. M3 is the longer-term debt instruments, and M2 is the shorter-term money. So people are not, are getting more liquid, and banks and institutions are getting more liquid, and they're not going long-term with their investments. One of the most remarkable things, the housing market, of course, imploded because of the insane policies of Alan Greenspan in pumping money into the system. And this shows that the housing starts have barely come back to the bottom of previous recessions. So in spite of all of this money being pumped into the system, new housing starts are continuing at recession levels. There have always been people who have not bought into the mainstream and have refused to drink the mainstream's Kool-Aid, and these are some of them that you see: Ron Paul, Peter Schiff, Jim Rogers, David Stockman. I've had all of these gentlemen on my radio show from time to time, John Williams, who we talked about. So who do you believe? I mean, America's Vestia, or do you believe that the corrected GDP, which is really confirmed by the lack of confidence in the American consumer, is really where the American economy is? I believe that, certainly quantitative easing has been a huge failure in delivering what the Fed says its mandate is, that is full employment and controlling the price rises. And of course, they have their own statistics to try to back their claim up. But if you use the reality of the story, I think is much different. I think, though, that the Fed has been a huge success in protecting the banks and redistributing wealth from Main Street to Washington and to Wall Street. Besides the rich getting richer, what are the consequences of infinite creation of money? Well, history is clear. It is ultimately the total destruction of the currency. The dollar has been in a destruction mode since 1971, but now we're seeing an acceleration of it. And the big thing is the debt. The debt is unbelievably out of control. We've seen a bit of a rollover. That tiny little turn down has occurred as a result of the very, very painful Lehman Brothers credit crunch. But look where we're at. I mean, it's still we're still far higher than we were at the previous highs of the 1932, 1931 timeframe, and that ratio fell off the table, debt to GDP, because GDP, that is, I say that ratio rose to those heights of 280% compared to 380% now, because GDP fell off the table back in the 1930s. That hasn't happened now. Well, it's not globally. I don't think it's occurred much at all in the United States, but globally we're seeing a loss of confidence in the dollar. So we're seeing a reduction in the dollar holdings as a reserve currency from 36.6% to 28.7%. Meantime, we're seeing gold increase from 10.45 to 12.79% as reserve assets of central banks. And we're seeing the euro decline as well, understandably, from 14.04 to 11.63. The other currencies are picking up. And we're seeing gold being held, especially moving very strongly to OPEC countries, but more importantly to China, Russia, and India. Huge amounts of gold going there. Real money is being transferred from the West, is going to those countries. Now, I talked about deflation, and I honestly believe that that is the underlying pressure, is deflation. Whether we could get inflation, I think if the dollar is destroyed, and I've had Alistair McLeod on my radio show recently made a very good point. He says, think Iceland. He says, really, the quantity of money is no longer such an issue because there's no backing of money. It doesn't mean anything. It's all a con job. And once people lose confidence in the currency can lose its value overnight, as Iceland did. Without any increase in the money supply, the Icelandic currency went in half within 24 hours. Well, if we get that sort of a thing, then I think we could be off to a hyperinflationary event. But the dynamic, the ongoing dynamic, if the Fed stepped away and stopped printing money, is there any doubt that we would have an implosion of a lifetime? Now, what does this mean for gold? Actually, Bob Hoy, who I've had on my show, has done some very interesting research and has showed that if the real price of gold generally tends to rise during deflationary events, and that is very bullish for gold mining companies. I measure the real price of gold relative to the Rogers Raw Materials Fund. And here you can see a major increase in the real price of gold following Lehman Brothers, from around 18% to 44% within a few months after Lehman Brothers. It continued to rise to 49% at one point in 2012, and then we started down again. And with that has come a major decrease in the mining company profits, and also in the share prices, of course, a very painful decline in the share prices. I believe that we're going to see another rise in the real price of gold very, very soon. I think we're going to see some major problems in the economy that come to light again, and that the happy talk and animal spirits will again fall into despair. And when that happens, I think we're going to see gold rise very dramatically again. With respect to the recent pullback in gold, I think it's very important to put it into history, in the context of history. In the 1970s, I'm old enough to have lived through that bull market. My good friend Peter Spina was not with us then at that time, but in the 1970s, we're looking at a major decline from $185 to $103. That was a 44% decline. This time we haven't seen anything like that. If we had, we would see 1,059, which I think is still an outside possibility for gold. But if we rose like we did after that decline in 1980, we would be looking it's a 721% rise. We'd be looking at a gold price north of $8,000, which I think is very much a possibility. I write a newsletter too, J. Taylor's Gold, Energy, and Tech Stocks, and I do pick a lot of stocks in that. And I just mention here a few of my favorites that I like a lot. And I'm really sticking a lot right now with companies that are, well, project generators because they don't have to issue a lot of shares. They don't have a big burn rate. And so while their share prices haven't performed very well, they have not had to dilute their shareholder interest nearly as much as most of the other companies have. But there are a number of companies that are well funded before this downturn that are in great shape, that are doing very well, and some of those you'll see there mentioned. And so I'll just leave you with that. These are some of my favorite companies. I do favor, outside of the project generators, I like companies mid-sized to smaller, new producers with lots of upside exploration potential to grow their production and their earnings. And there are a number of companies that I feature in my newsletter, J. Taylor's Gold, Energy, and Tech Stocks, and you can go to mining stocks to learn about my newsletter. You can also go to J. Taylor Media, which will really get you to my radio show, my newsletters. Also, Chen Lin, a partner of mine that does excellent work, provides a newsletter which is accessible there as well. I might just mention Prophecy Platinum at the bottom of your screen, the Well Green project. You just listened to Greg Johnson. I can't say enough good about that project. It is one of my favorite stocks. I own it myself. I recommend it in my newsletter as well. I think that it could be the top Prophecy Platinum. It could be the top platinum group metals project in the world. And I just, before Greg started talking, I just happened to pick up an article from Eric Sprott talking about the tremendous needs of China for platinum in order to try to clean up their environment. So I think there's lots of opportunities out there right now. I think there's lots of opportunities. I've been telling my subscribers on the way down in this correction to cash out, even if you had to take some losses, and build some cash. And I think we're in a bottoming period now in the gold market. I think we could see another decline down to around the 1,000 level even. It's possible. But I think we're getting very close to a major move. And Dr. Robert McHugh, who was on my show this past week, believes that we are getting within 6 months to a year of the next major leg up in the bull market in gold. And he says this is the fifth wave up in using Elliott wave analysis, and that in the precious metals markets, the wave 5s are by far the biggest waves up, and wave 3 for equity markets. But he thinks we're going to see a major equity market decline, and that will coincide with a major bull market in gold and silver, and that will probably parallel, in my view, on a much larger scale, what I saw as a young man back in the 1970s after gold corrected and then went up from about $100 to $850. Now, I wish it weren't so, but I see all of the lies and the propaganda and the Keynesian economics that is laying the groundwork for the death and destruction of our economy. And so the only way, when this dollar goes to zero, the only way to preserve your wealth is to have tangible assets. And of course, the most fungible and the most logical ones to own are gold and silver. That's really all I have to say right now, Peter, unless there's time for a question or two.
Yes, well, thank you very much for the presentation. That was really insightful. We'll be uploading this presentation to our YouTube channel in the next couple of days and posting it on GoldSeek and SilverSeek.com so people can go ahead and review all these great statistics and slides that you presented. Just a question here as we're presenting the FOMC's meeting right now to determine whether they will continue their easy monetary policies or they may even taper. What are your thoughts on today's decision and the upcoming FOMC meeting?
Well, Peter, I think they can't really decline. I think they can't really taper. I think they have to, if anything, accelerate the growth of funny money. And yeah, I don't think they can do it. I think they'll try to pretend they can do it. I mean, I was watching CNBC this morning, and they had some guest on there that was trying to say, "Oh, it'll probably be early next year." Well, we've heard this song and dance before. They can't do it because the mere mention of pulling back this money creation sent Wall Street into a hissy fit. And I think that what's going to happen essentially is that we're going to see a major increase in the acceleration of money creation out of nothing. And I think that is when we might see the equity markets tank, and we might also see gold and silver take off. It's also possible that the equity markets would accelerate on that news because of the liquidity, and people will run towards things of value. But I also think that if people start to realize that the dollar is going to be created infinitely, there's no end to it, that then the mix of kinds of things they might start to buy would be similar to what they bought in the 1970s when the inflation rate started to rise, and that was oil and gas stocks, commodity-orientated stocks, and of course that would include gold and silver stocks, which did extremely well in the wave 5 up in the 1970s. But I don't think there's any way, Peter, I don't think there's any way in the world that they're going to actually decrease the money supply or hold back in the growth of the money supply even. But if they do, we're going to see a spiral downward that will make, I think, the 2008-2009 decline look like child's play.
And we polled our audience as well, listening live to this webinar, and 83% also agree that there will be no tapering today. I concur. I don't believe that they can do that. And regarding the money printing and purchasing of bonds, right now the average Treasury debt is being financed at 2.43% with this controlled or suppressed interest rate. So it's kind of keeping this game going with $17 trillion in debt and growing. But with that, it doesn't really create an incentive for foreigners to purchase our bonds at these levels. And we've seen that capital outflow. So are we reaching some sort of tipping point where we see a rush of selling of these bonds, and which may require even more aggressive buying by the Fed? Or
well, I think so, Peter. I think there's no question about it. And at the same time, I believe that China actually increased their purchases or increased their holdings of dollar of treasuries. But yeah, I mean, I think China wants to get out of it, and I think there's more and more talking. The Chinese are recently talking about getting rid of the dollar as the reserve currency. I mean, clearly I think they're building up their gold reserves in order to provide an alternative. China and probably maybe the BRIC countries, an alternative to the dollar. They're tired. They're sick and tired of the United States picking the pockets of them of the rest of the world and using funny money. And why in the world would China continue to support the U.S. and its military efforts when it's competing with the United States for raw materials around the world? So I think there's a big geopolitical confrontation very possibly coming up. And more than anything, I think the dollar is the crux of the matter. I've had Mr. Perkins on my show a couple of times, and he was convinced that the reason we went into Iraq was to enforce the dollar standard. And so, no, I think, but at the same time, why would anybody want to own the U.S. dollar when it's sick, when the underlying economy is sick and sicker than what they're letting on? So, I think we are close to a tipping point, but it's always dangerous to try to predict times, because we are talking about psychology, after all, to a great extent. In spite of my put down of the animal spirits notion, really, we are running on animal spirits to a great extent. We are believing in a currency that has absolutely no value at all. It's just a con job. And the day that comes, then people start to understand that. Certainly the Chinese and other people, sophisticated investors, understand that. But when the day comes that confidence is lost in the dollar, the game is over. The game is over. And then is when I think we could get a hyperinflation. But I think the predominant pressure right now is deflation. And if we deflated, if we could actually pull a Paul Volcker again and pull back creation of money and credit like Paul Volcker did in 1979 and 1980, then the dollar would become extremely strong. I think gold would go to extremely high real levels. It would probably decline in nominal value, but gold would start to buy much more of everything else. And if I had my choice, I'd rather see them taper. That's what they should do. They should just pull back the money supply. And then we could really start to have interest rates reward savers and penalize borrowers. That's what we really should do. But they won't do it because it would be too painful. So, either way, you have to be extremely bullish on gold and silver, Peter.
Absolutely, and then John Perkins' book, that's Confessions of an Economic Hitman.
Yeah, that's correct.
Which is really, Chris Mullen, our content manager at GoldSeek here, and myself had the opportunity to meet with him here in Denver years ago, and really enjoyed his perspectives and insights into that book. It really is it's a must-read. Well, we'll look forward to the FOMC announcement here in a couple of hours, and we'll continue to watch this unfold. So with that, Jay, thank you very much for your time. And again, to your websites are moneystocks.com and jtaylormedia.com. Is that correct?
Yeah, jaytaylormedia.com is probably the best place to go to access everything that I do. And I want to thank you, Peter, for the opportunity to talk with you and be on your show.
Likewise. All right. Thank you very much.